Good morning, everyone. Welcome to this session of Strategic Financial Management. And in our last session, we were discussing the sixth chapter Institutional Setup for Term Financing and Working Capital Finance. And we had discussed regarding what do we mean by term financing, how does it work, and why is that term financing matters for any business organization, and what do we mean by commercial banks. In today's class, let us discuss briefly regarding working capital. Since you have already studied regarding working capital, let us just sum out it in very brief way. Now, for doing business, the organizations need liquid cash in its hand, and this liquid cash is very much necessary to do day-to-day operations or to solve the day-to-day financial obligations. Maybe for paying wages, salary, electricity bills, or any such kinds, or in other words, which includes current assets or liabilities. Now, speaking about working capital in accounting terms, in very simple words, now all those assets or liquid assets that remains in the hands of the business organization when it deducts current liabilities from current assets is called as working capital. Now, this working capital always tells about how good a company is to meet its short-term obligations. Now, speaking of short-term obligations, current assets and current liabilities both are always referred to as short-term obligations. Now, there are many sources of working capital, some of which can be the net income that is earned by the company. The second one can be long-term loans, sale of capital assets, and if at all there is gain from that, and the funds by stockholders. Now, whenever an organization has enough working capital, it always helps the company to be on the advantageous side or to take the advantages of any opportunities that might arrive unexpectedly. And also, whenever an organization needs bank loans or credit from any of the institutions, one main thing that the institutions see is how will the liquid cash is maintained by the company. So it is said that the more or the favorable working capital of a company, it would be helpful for the company to get or receive credit from outsiders. Moving forward, there are different types of working capital. The first one is factoring. Now, this factoring is a very traditional source of short term funding. Now, what happens under factoring is that factoring facility arrangements, it tends to be restrictive and also entering into a whole turnover. Now, there are chances that sometimes these factoring facilities can lead to aggressive chasing of outstanding invoices from clients, and also it might result in loss of company's credit function. Now, to speak of factoring in very simple terms, this is one such type of transaction which can be regarded as debtor finance. Okay, in this, what happens is that I having some amount of account receivable, or in other words, the money that the outsiders owe to me in form of accounts receivable or invoices, all such accounts receivable, I would be selling it to a third party. And here within, the third party is called as factor. And this I would be selling for what is called as a discount. Okay. Now, this many a times is used by business organization, or it is sold by business organization to meet its present or immediate obligations of liquid cash. Now, forfeiting is also a kind of factor arrangement which is used in international trade by finance exporters who wish to sell their accounts receivable to a person called as forfeiter. Okay, and this factoring has been referred by different names. It is also called as accounts receivable factoring, invoice factoring, and sometimes simply as accounts receivable financing. Now, what we discussed regarding accounts receivable financing is a term which is, accurately used to describe a form of asset based lending against accounts receivable. Moving forward, the next one is installment credit. Now, this installment credit is a form of finance to pay for goods or services over a period through the payment of principal and interest in regular terms. We have all known this in terms of maybe uh, while making payments for any kind of electronic items, especially they would have an option of buying the goods for the initial down payment, and for a fixed time period equal installments of the principal amount has to be paid. Now, it is a form of finance which is used to pay. It can be either goods or also service, and there would be a fixed time period, and the payment would be the principal plus some kind of interest. Or in other words, it is simply a loan to, made towards fixed payment. Now, as we said, it will have interest rate, repayment terms and fees, and it will also tell how much has to be paid per month. Now, it can be in type of mortgages, car loans, or personal loans also. Now the third one is invoice discounting. Okay. Now it is a form of asset based finance which enables a business to release cash which is tied up in an invoice, and unlike what we discussed regarding factors, it always enables a client to retain control of the administration of its debtors. I would repeat it once again. Now, invoice discounting is a form of asset based finance which helps a business to release the cash that has been tied up in the form of invoice. But unlike factoring, invoice discounting enables a client to retain control over the control of and the administration of the debtors. Now, speaking about this, as it has been shown in the PPT, this invoice discounting is a practice of using the company's unpaid accounts receivable. It can be in the form of, a collateral for a loan. Now, this type of discounting is used for very short term of borrowing, because the finance company can alter the amount of debt outstanding as soon as the amount of accounts receivable changes. Now, the amount of the debt which the finance company uses is always less than the total amount of outstanding receivable. Okay, usually it would be 80% of the invoices that has less than 90 days. Okay, now this invoice discounting, you know, it usually helps in accelerating cash flow from customers, so that instead of waiting for customers to pay within their normal credit terms. Otherwise, to help you all understand the concept of bills receivable and bills payable, what we had, now invoice discounting or factoring is some other kind of bills receivable and bills payable. The next one is income received in advance. Now, income received in advance is the income that a business organization earns in the current year, which would be of the coming year or of the coming time. Therefore, this income received in advance is always treated as liability. Now, whenever a business earns some income which is of the future date, the income would be credited to income received in advance. Okay? And when the time comes, it would be debited in the income account. It could be in the form of rent, or any kind of bill, or the insurance payment, or any such things. The next one is advance received from customer. Now, this advance received from customer is also a liability. Okay, Now, this uh, amount which the business organization earns even before the service or goods has been provided to its customer is called as advance received from customer. The next one is bank overdraft. Now, usually what happens is that we can save our money or deposit our money in the bank, and whenever we require, the bank would be providing us with our money. So when we deposit, our account would be credited. When we withdraw, our account would be debited. But there is an option of overdraft. Now, whenever a business has overdraft account, the account from that account we would be able to spend more than to a certain fixed limit than what is actually there in bank account. Now, this overdraft is also a type of loan. The next one is a commercial paper. Okay. Now, a commercial paper is usually an unsecured promissory note. Now, speaking about commercial paper, it is a paper in the money market security which is issued by large corporations. Now, the large corporations issue so that they get money to meet the short-term debt obligations. Now, the short-term debt obligations can be in the form of payroll, and these commercial papers are usually backed by an issuing bank or corporations promise to pay whatever amount or the face amount on the maturity date that has been specified on the note. And one more thing about commercial paper is that since it is not backed by collateral, only those firms which has excellent credit ratings will be able to sell their commercial papers at a reasonable price. Now, once again, speaking about commercial paper, a commercial paper is a unsecured promissory note, and these commercial papers are called as money market securities. Now, these commercial papers are issued by large corporations to get money which it uses to meet short-term debt obligations. And these commercial papers are only backed by issuing bank or corporations. Now, these issuing corporations or corporations, when they give promissory note, they promise to pay the face value or the face amount on the maturity date that has been specified on note. Now, since it is not backed by any kind of collateral, only those firms which have excellent credit ratings will be able to sell their commercial papers at reasonable rate. Now, the next one is letter of credit. Now, a letter of credit is usually a document that a financial institution issues to a seller of goods or services, and this type or this letter of credit says that the one who has issued or the issuer will pay the seller for buying goods or services. Now, the seller delivers to a third party buyer. Now, what happens that is the issuer then seeks the reimbursement from the buyer or from the buyer's bank. Now, this usually acts as a guarantee to the seller that he will be paid by the issuer of the letter of credit regardless of whether the buyer ultimately fails to pay. Or usually an exporter requires an importer to prepare for goods shipped. Now, the importer naturally wants to reduce risk by asking the exporter to document that the goods have been shipped. The importer, there is somebody called as the importer's bank and the exporter's bank when the under export and importer. Usually under the letter of credit, the importer's bank assists by providing a letter of credit to the exporter, or sometimes can also be sent to the exporter banks by providing for payment upon presentation of certain documents. Now, those documents are in form of bill of lading or any other kinds of bills that is used in exports or imports. Now, the exporter's bank may make a loan to the exporter on the basis of export contract. So, this letter of credit is usually used under export and import business. Now, usually the other kind of long-term sources of working capital finance are, one is equity, the second one is loan. Now, equity could be in the form of preference shares or equity shares. Now, regarding the equity and loan, we have already discussed in our first chapter or in the introduction chapter in a very detailed manner. So, moving forward, there are some of the institutions in India which helps the business organizations to have, or which provides with the funds that are necessary for business organization. The first among those is Industrial Development Bank of India. Now, speaking about IDBI or Industrial Development Bank of India, it was established in the year 1964 on 1st July. Now, the government of India established IDBI under an act of parliament as the principal financial institution of the country. Now, the main work that IDBI does is that IDBI provides assistance to especially small scale sector through its scheme of refinancing and also bills rediscounting schemes. Now, the financial assistance usually be in the form of indirect finance, like might be refinancing of loans, and also sometimes through SFCs, or what we call as state financial corporation. And IDBI, to help the small scale sector, has also set up SIDF, or what we call as Small Industry Development Fund. And IDBI established SIDF in the year 1986. Now, the funds that are being given by SIDF is basically aims at providing uh, such finance to coordinate financial and non-financial inputs required for growth of small industrial sector. And in association with the government of India, IDBI has constituted NEF, or what we call as National Equity Fund, to help or to prevail equity type of support to tiny and small scale units which are engaged especially in manufacturing activities. And all these schemes under NEF, or National Equity Fund, is administered by IDBI through nationalized banks. Okay. Along with this, IDBI has also introduced what we call as single window assistance scheme for granting of term loans and working capital assistance to tiny, small and also medium scale enterprises. Now, speaking about the single window assistance means that all the documents that is necessary in taking loan would be submitted at one single place itself. Now, IDBI has also set up what is called as VECC, or Voluntary Executive Cooperation Cell, which helps to use the service of experts, professionals, for counseling small units and for providing consultancy support in some of the specified areas. Moving forward, the next institutional setup is IFCI, or Industrial Finance Corporation of India Limited. Now, even IFCI was set up by Government of India under the IFCI Act in July 1948. Now, IFCI is an important financial institution which gives financial assistance to the entrepreneurs through not only rupee but also foreign currencies in form of loans, underwriting, direct subscriptions to shares, debentures and also guarantees. Now, along with these functions, it also extends other financial facilities like help during the equipment procurement, equipment finance, buyers and supplier credit, or maybe equipment leasing and finance to leasing, and also sometimes hire purchase companies. Now, there are some of the promotional schemes which are being devised by IFCI, such as consultancy fees, subsidy schemes for assisting small scale entrepreneurs in marketing sector, and also interest subsidy schemes especially for women entrepreneurs, and some of pollution control in small and medium scale enterprise, along with that encouraging the modernization of tiny, small and medium scale industries. Now the third one is Industrial Credit and Investment Corporation of India, or what we call as ICICI. Now, ICICI was established by Government of India under Companies Act of 1956. Now, ICICI has the objective of providing financial assistance to the small and medium scale sector. Now, this ICICI helps in assistance of finance by extending it in the way of rupee and foreign currency loans, and same as the working of IFCI. Here also these loans can be in the form of underwriting, direct subscription to shares, debentures and guarantees. It also provides financial facilities such as maybe deferred credit, leasing credit, installment scale units, asset credit, and venture capital is also given by ICICI. And ICICI also guarantees loans from other private investment sources, small scale units, I mean to tell, uh, whatever the loans that are given by ICICI or the guaranteed loans that are given would help these private investment sources, the small scale units, and the tiny and medium enterprises. The next institution is LIC, or Life Insurance Corporation of India. LIC was established under LIC Act in 1956. Now it offers many insurance policy which gives social securities to various segments of the society. Now, as per its investment policy, LIC invests 75% and above in central and state government securities, including government guaranteed marketable securities, and in the socially oriented sector. Now, LIC also gives loan for activities like housing, rural electrification, modernization of industry, expansion of industry, diversification of industrial ventures, water supply, sanitation, and other such The next one is UTI or Unit Trust of India. Now, UTI or Unit Trust of India was set up by Government of India in 1964 under one of the Act of Parliament. Now, the chief or objective of UTI is to mobilize savings or to collect savings of small investors through the sale of units and thereby channelize these savings towards corporate investments. Now, this UTI has introduced many schemes which aims at common investors. Now, these schemes are mainly primary equity fund, retirement benefit plan or Griha Lakshmi unit plan, unit scheme 1995 and Columbus India fund. The UTI also provides financial assistance to corporate sector in the form of term loans and underwriting, direct subscription to shares and debentures. The next one is SIDBI or what we call as SIDBI or Small Industrial Development Bank of India. Now, speaking about SIDBI, it was established in 1989 as a subsidiary of Industrial Development Bank of India under a special act. Now, the main function of SIDBI is the promotion and development of small sector industries by the way of providing finance. Now, SIDBI commenced its operations from 2nd April 1980 and its head office is located at Lucknow. Now, the initial authorized capital of SIDBI was 25 crore, which has been extended up to 1000 crore. Now, the main function of SIDBI is, as we said, to promote small scale industries in semi-urban areas to create more employment opportunities. Now, it also functions to undertake technological upgradation and modernization of existing small scale industries. Now, the SIDBI also helps to expand the channels for marketing the products of SSI sector on both domestic and also in industrial markets. Now, SIDBI also extends seed capital or soft loan assistance under National Equity Fund scheme, or there is one scheme which can be specifically said as Mahila Udyam Nidhi scheme. Now, speaking about soft loan, under soft loan, mainly what happens is the rate of interest is lesser than the rate of interest that is prevailing in the market. Now, speaking about seed capital, it is nothing but the initial capital that is necessary to start a business. And SIDBI also helps in granting direct assistance and refinance for exports of small scale sector. The CDB has the function which provides financial assistance for SFCs, SIDCs, commercial banks, RRBs through existing credit delivery systems. Now, speaking of SFCs, SFCs are nothing but state financial corporation, uh, and SIDCs are, you know, still India Development Corporations, and RRBs are regional rural banks. And SIDB also provides factoring and leasing service also. And SIDBs provide financial assistance to institutions, organizations, especially for taking up EDPs, or what we call as entrepreneur development programs, and also special emphasis and the new schemes for assisting marketing support to the small scale sector. The next one is Industrial Reconstruction Bank of India, or IRBI. Okay. Now, IRCI, or International Reconstruction Corporation of India, was set up in 1971 under the Companies Act, and it was set up to act as an agency to rehabilitate the sick units. But what happened is that in the year 1984, the government of India renamed the IRCI as IRBI, or Industrial Reconstruction Bank of India, by an act of parliament. Thereafter, IRBI acts as a reconstruction agency to review, reconstruct, and also rehabilitate the sick industrial concerns. Now, IRBI plays a significant role in promoting both entrepreneurial and industrial development in the country by performing some of the functions, like it helps and provides financial assistance to industrial concern. It also acts as an agency of state government, union government, and other financial institution as per the authorization of the government. It also provides consultancy and merchant banking service for reconstruction and development of industrial units. It also helps in providing infrastructural facilities, raw materials, machineries, and other tools on the basis of hire purchase and lease schemes. So, in our today's first session, we have discussed regarding working capital and different types of short-term sources of working capital and also long-term working capital, and 7 of the institution setups which helps in bringing this working capital finance. And in the next session of today's, we shall continue with the further institutions which helps business organization to bring in the necessary funds for the organization. For this session, I have taken down your attendance. As of now, you can leave the meeting and join once again for SFM class around 12 o'clock. Thank you.